Hey guys. So there's a common question that is always floating around in my mind of how much would this house that I'm sitting in right now cost me in today's dollars? So just to give you some context, I bought my house in 2022 at a rate of 3.85%. So I got a very, very good interest rate on my house, and I'm sure a lot of people got a really good rate on their house as well. But the truth is sooner or later, you have to start thinking about, well, maybe one day I have to move, either due to work or maybe I get in a relationship and then end up having to move. How much is it going to cost me if I bought the exact same house today in today's dollars from interest wise? So this is the current mortgage interest rates as of today. You could do a simple Google search just to find this, just like I have. And as of right now, with the credit score of where I'm at, because I'm at over an 800 credit score, the 30-year fixed rate is 6.43%, and the 15-year fixed rate is 6.9%. So if you were to secure a loan as of today, this is what the rates you would typically be paying. Obviously, there are a bunch of other factors, the company you go to, the rates that they're offering. But just for today's example, I'm going to use 6.43% as the interest rate. And I want to explain how much would my house cost in today's dollars if I were to buy the exact same house right now. So first thing I'm going to do, I'm just going to come into my mortgage calculator that I have and actually enter in some numbers just to duplicate what I'm doing right now and what I'm currently paying at this moment. Okay, so I've got this one pulled up, and let me go ahead and open up another one and put 6.43% as that. So all the scenarios are exactly the same, but now let's compare it. So believe it or not, we would be paying close to $300 more a month just with principal and interest. So immediately, it's very apparent where the money's going to be going. The banks are going to be obtaining more money, and the mortgage companies are going to be obtaining more money from you from buying a house today. So clearly, the winner of the most amount of money that it's going to cost is going to be right now, because higher interest means you're paying more money across that period of time. In 30 years, that rate is staying the same. So 6.43%, you're paying a lot more interest. So the same house, total cost for the life of the loan, right now, when I'm done paying this off in 30 years, and that's my hope is to pay it off early, but $328,000 is what I would end up paying in principal and interest across the total life of the loan. But in today's dollars, if I were to buy this house, this exact same house that I'm sitting in right now at this interest rate, I would be paying almost $500,000 for the same exact house. It's a little sickening if you stop and think about it. And the total interest, you're going to end up paying over $111,000 more in interest. Like literally over $111,000 of your income is going to be wiped away over 30 years in total interest. So you can imagine staring at the total interest of the home right now. I'll be paying $133,000. So I'm basically buying another home for the mortgage company. So the interest I'm paying them goes towards them buying something else and reinvesting it. I mean, talk about a great investment. I wish I was a mortgage company. And if I bought the same house today, I'd be buying the exact same equivalent of my home. So I'm basically buying two of the same homes, but I'm only living in one. It's a scary comparison. And the total percentage of interest, excuse me, is 40.75 right now. That's still relatively high in my opinion. I wish it was only 10%, but again, I'm not the one who put up that much money. So of course the mortgage company has to make their money back and then some. But if I bought the same house in today's dollars with the same interest, I'd be paying over 55% interest on this house, doing the exact same comparison. So just a slight jump. So we're talking probably almost a 50% or 100% jump in interest rate. You're paying more interest than what you are going to expect to do. So clearly, this is a winner for saying, man, we're going to be spending a lot more money. So nothing changes down below, in terms of, the total estimated tax and insurance, but the total estimated monthly payment, clearly goes up. if you're paying, principal and interest and home insurance and taxes, the price of the home isn't changing except your payment went up. So, in today's dollars, I'd be paying a heck of a lot more. The payment I make is 1,500. I always put $200 extra on my payment. That's just what I prefer to do because I do want to pay the house off early. I wish I could treat it like a 15-year mortgage. I probably could, but I would really struggle to financially support myself each month because I'd be putting so much money into the house that I wouldn't have anything left over to spend. Um, but again, if in these scenarios, you can ignore the private mortgage insurance because I did put 20% down. So really the whole perspective here is to kind of tell you that, look, if you were to buy the exact same house today in today's dollars, it's going to cost you, at least an extra amount of one other house. So, this is just the scenario for my home. Lord forbid if you were to plug in your exact same house today that you bought back in 2021 or 2022 and got a very, very good interest rate. And if you say to yourself, well, what if I were looking for the exact same type of house? What if I sell this house today and go buy another one that's the exact same? Well, clearly you're going to be paying a lot more for it. And in other words, a lot of people end up having to downsize in the house. And just because you downsize in the size of the house doesn't necessarily equate to cheaper in today's market. If you look at homes in today's market, you would probably be surprised that they are still relatively expensive. And I mean, for homes that are older and homes that are more brand new, you're looking at entry level price in some housing markets at $250,000. And I used to think entry level to a house is 150. Well, in 2024, it's absolutely bonkers the price of homes. So basically what I'm saying here is if you're in a low interest rate mortgage, you are probably better off sitting on that low interest rate mortgage until you can see that the interest rates drop around the same amount or just a little bit above what you're currently paying right now, because it makes no sense to move somewhere else or go and buy another house if the interest rates are not lower. So I hope you all enjoyed this. I hope this helped give you some perspective on how things work with a mortgage, especially when the rates are higher. So thanks you guys for watching.